Hey guys, it's Emac here. Today we're going to talk about the simple path to wealth. So in fact, I'm going to share all my experience, all I know about investment, retirement, and how to be, set for that time. Plus a lot of summaries and tips and tricks that I've learned from many books. So the first thing we need to understand is the concept of debt. When you have debt, first thing, you are paying interest. That money costs something. And the second thing, you are losing the opportunity to invest that money somewhere that can generate more money for you, right? So if you spend like $200 a month, you might say, oh, you know what, $200 a month, it's not going to go anywhere. I'm not going to get rich with that. And I understand that. But let me explore a concept here. When you put your money in an investment, model, which I'm going to explain what type of investment you guys can get in, what happens, you basically take advantage of a concept called compound interest, right? So your $100 will be $101 next year, for example. That's just an example. And then next year you have $101 to invest. And that $101, it's going to generate interest, and it's going to add to your principal, to your main money. So your money is growing all the time, and it's generating interest accordingly. So you need to understand this. So American dream, a lot of people think, is just buying that fancy car or driving that BMW and buying that fancy nice house, right? Of course it is, but it's nice to have all those things, but you need to first of all build your wealth and build an engine that can basically give you that lifestyle, right? You're not supposed to work all the time around the clock to pay for that car. So there should be a system that works all the time that basically pays for that fancy car and for that nice house. So instead of driving a $60,000 or $100,000 car in your 20s or your early 30s, you need to spend that money, basically invest that money somewhere that generates more money in the long run for you. So we understood the concept of debt and the impact of debt. The second thing we need to understand is when we have extra money, when we are not driving that expensive car, so now we have some extra cash flow every single month from our paycheck, from our work, that we can spend somewhere, right, that can bring us more money. A lot of people say, oh, you know what, I don't know investment, I'm not familiar with investment, and I'm not interested. So I'm just going to go ahead and hire someone, a financial advisor with a nice suit and a nice tie, and it looks very sophisticated, and that person is going to take care of my money. Wrong. That person is not going to take care of your money, because that person, that financial advisor, is just going to charge you 1 or 2% per year, and you're going to say, you know what, not a big deal, 1-2% is not a lot. In fact, it is a lot. If you look at it over like 20-30 years, you're talking about like few $100,000 in total. So remember, avoid a financial advisor. If you need financial advisor, go pay for the hours. Don't pay percentage of your investment, right? But you say, okay, but I don't have good understanding about finance. I don't have good understanding about stock market. I don't know how to invest. I don't understand the risk. Very easy. I'm going to tell you why. So first of all, stock market is the best vehicle to build wealth. After running your own business, if you are running your own business, good for you. That's going to make you money if it's successful. But the next thing that actually it's a great tool to build wealth is stock market, right? So stock market in general, if you look at the history of stock market always grows, right? And in fact, if you think about it, behind stock market, what exists is just a bunch of companies, bunch of people like you and I, bright minds who are helping the world, right? Who are helping people. They generate value. They are people behind those businesses. So when you put your money in stock market, basically you are putting your money behind that business. You believe in the business. You own part of that business. You become part of that family. Understand that stock market is not just a game in picking some numbers. Stock market is actually investing in companies. So those companies, they grow over time, they add more values. And if you think about it, 20 years ago, the companies didn't have a lot of technologies. These days, companies are bringing more technologies to market. So they bring more value. So of course, the value is going to go up. So over 20, if you look at the time, over 20 years, over 30 years, the stock market is always profitable, right? But a lot of people, they get to this emotion, to this basically roller coaster ride. Every day stock goes up, goes down. Oh, it went up, so I'm going to sell it. It goes down. Oh, I'm going to buy it. Don't do that. Avoid that pattern. Let your investment grow. But if you're not familiar with the stock market, I'm going to share one real easy way to make money over time. Again, over time. This is not a fast, recipe for you. Over time, you're going to be rich. So if you are familiar with a little bit finance and you understand how businesses work, of course, you can go ahead and buy your stock. If you believe Netflix is a good company, by the way, I'm not sponsored by any of these companies, any of these books. This is just the talk and my personal experience sharing with you. And please, talk to your financial advisor or whoever you want to, but listen to what I have to say, and then you can judge on your own. So imagine you believe in a company and you think it's going to be a great company, they're going to do well in long run, and then you put your money in that stock market. So if that company grows, your money is going to grow very easily, very nice, life is good. If that company fails, you're going to lose your money. So of course, that's a trade-off. That's a risk you take to make money. But is there any better way if you're not comfortable with stock market, if you don't understand stock market and you don't want to risk that money? Yes, there is. So, and the answer is index funds. So index funds, they are baskets that, well-educated, trained financial advisors put those companies in that basket. So imagine you have a group of companies in one basket called an index fund, right? And it's actively managed by a company or by a group of people who have good understanding of finance and economy, right? So again, over time, the history shows all those index funds, they always grow. They'll always grow, right? So think about it, over 20 years, 30 years. In short term, yes, some of them fail, some of them, there's going to be ups and downs, but you don't care about those, as we talked about. So, of course, when you put your money in index funds, the risk is very, very low. And the reason is that if, let's say, there's 3,000 companies in that index fund, if 10 of those companies fail, you don't care, because very little percentage of your money is distributed, it's been assigned to that small company. So basically you're risking on a very, very little amount of your money, but on the flip side, you achieve a lot, because a lot of those companies, which is, being picked by, well-educated, well-trained financial advisors and actively managed, they're going to grow and they're going to make it. So your money is going to grow as well. So remember, if you don't understand the stock market, even if you understand it, I definitely recommend put your money in index funds, right? And you have to pay attention. And when you put your money in index funds, you have to pick the ones that have very, very low cost, because the cost is where all those financial advisors make their money. If they're saying, oh, it's just a 1%, no, it's no good. If it's 2%, no, it's no good. But what is the best index fund in the US? So I can tell you right now, again, I'm not sponsored by Vanguard, but Vanguard has an index fund called VTSAX, and you let it go every single month. You add to that. Bunch of people are managing that, and since it's an index, it's very low risk, and it's going to grow over time. So you're going to end up waking up one day rich. But this is going to happen over time. This is not going to happen over 2 days or 1 month or 6 months, right? That's not the right way to get rich. Okay, so we talked about the concept of debt, and now we learned how to regularly invest in low-cost index funds without being worried about stock market fluctuations. So you focus on your programming on whatever you want to do, but or your main job, and then you let all those financial advisors who are managing that index fund with low cost manage your fund, and over time you're going to end up getting rich. So that's the second thing. And I already told you, avoid financial advisors. If you need advice, just find the one who accept like hourly or just a project based. Don't commit to any percentage over long run, because you're going to end up losing a few $100,000 money. So that's the second thing. And I'm going to share you a few tips from a person called Dave Ramsey, and he has a great book. He has like 6-7 steps. I'm gonna give you very little summary here because there's a lot of good points in his book. So the first thing he recommends is to have a emergency fund account, and that is very good practice, because a lot of times people need money, like for for car repair, for things like that, and they end up going out of their way in order to cover them. For example, they spend the money that they're supposed to, for example, invest on something for repair, which is not good. So he recommends actually put some money on the side, and he recommends $1,000. I recommend more than that, based on your family size and your needs. But definitely have emergency fund account and have that money in cash available somewhere. So if you don't want to just keep the money in house so it doesn't earn anything, you can put it, I recommend you can put it in money market account or high yield saving accounts, right? So you can earn some money. If you put it in money market account, it's available immediately, but at the same time it basically generates a reasonable amount of return, at least in the US. So that's about emergency fund. The second thing, start paying off your debt. If you have credit card debt, sort all of those credit cards by the amount of interest you pay. If you're paying a high interest on a credit card, that's the first priority. You have to pay that off. Remember, avoid debt. That's the first rule to financial independence and being rich, right? So once you pay off your debt, you can put some money on the side and start building like 3 to 6 months worth of like household like expense. Like, let's say if you lose your job, if something happens to you, or if you can't work, for 3 to 6 months you have enough funds to live off of. So build that. And then the next thing, if you have kids, you can start funding your kids' college, and then at the end pay off in the house. But regarding house, I'm going to actually share my own experience and my own perspective, and I'm going to tell you what I know from other people, so you can make the final decision before we wrap up this video. So house, at least in the US, I'm talking about US. If you're in a different country, please study the market, go through the pros and cons and see what works best for you, and let me know your thoughts in the comment section. But in the US, there's a lot of people think, okay, having a house is actual asset, which is true. So when you own real estate, it's good. So you own a house, or you own an apartment, and then over time it grows, right? Or it might crash. But in general, a lot of people think having a house is having an asset. A lot of people think, no, having a house is actually debt. They're both right? But what works best for you? You need to figure that out. But let me put some light on these two concepts. So in a book, Rich Dad Poor Dad, Robert Kiyosaki, talks about a very good concept about asset and debt. So what's the difference between asset and debt? Asset is basically things that put money in your pocket. Debt, it takes money away from your pocket, right? Well, so if I buy a car and drive it every day to work, and I'm paying $1,000 a month, that's taking money away from me. That's debt, right? I'm paying monthly fees. That's debt. If I have a car and I loan it to someone and brings me money, and that person pays me $1,000 a month, that's an income for me. That's an asset for me, right? Well, in our case, which is house, when you buy a house, usually the way it works, people go to banks or financial institution and they ask for a loan, and banks approve them. They study the the ratio of the debt to income, and they charge them a percentage for that money. They say, okay, your rate is 5%, 4%, 3%, whatever it is, for that mortgage loan to buy a house, and you put a little bit down payment money, and then you become an owner, right? But you have to pay bank for the next 15 or 30 years. It's based on the mortgage monthly money, which has all the interest and everything built in it. And in fact, you have a debt, right? Because if you look at banks' balance sheet, they own the house, so the house is actually on their balance sheet, right, on the asset column. And but the same house, it's on the debt column of your balance sheet as a person, because you are paying them on a monthly basis. So you have a debt and bank has the asset. But there is a good thing here. If the real estate market grows, which usually happens over time, the growth of that money is yours, right? Because you are the owner. When you sell the house, you sell it for more money and you have less loans, so you gain a little bit money, right? Or hopefully a lot of money. So the bank, you're just responsible for the principal amount of money, for the original amount of money that you borrowed from the bank, right? So the growth of the house is yours. That's a good part. So a lot of people say, hey, that's an investment for me. Well, it depends if you're in your 30s or if you have a family, or if you live in a place that you need a house and you're paying a high rent, so it's probably better to buy a house. So again, these are the pros and cons you need to understand, you need to think about when it's time to buy a house. On the flip side, if you're paying rent, you are losing money and you're not owning anything. So you have to study what works best for you. And the last thing, when you work for US-based company or any other company around the globe, make sure they all have retirement plans, different retirement plan. In US, majority of the companies, they offer 401k and they match, right? For example, they say we match up to 4%, up to 5%. It means you put 4% of your before tax money in that account, and they match it. They put 4% for you. Basically, it's free money. Remember, if the company is offering you 401k, take it. That's the free money. Take it. Okay, you understand? You put 4% before tax. So your money goes to an investment account and starts growing before tax. But when you take it out, when you retire, of course you pay tax. But right now, it goes to that account before tax. So that's one way you can actually lower your income and pay a little bit less tax. At the same time, put your money towards your retirement account so you can enjoy life later on. So definitely maximize your 401. On the other side, there's one more thing you need to do. Personal retirement account, you can contribute up to $5,500 for a single person. For married couple, there's different formulas. So it has a maximum basically contribution limit in the US, but that's the money basically you put in IRA account. It's basically tax paid, right? So you pay tax from your bank. So you already paid tax on your income, right? And the money goes to your bank account. Now you go to a bank, you say, give me $2,000. So that's money is already, you pay taxes on it. You take that money out, you go and open IRA account, which I recommend Roth IRA, because there's no penalty for things like that later on if you need the money a little bit early. But what you can do, then you open a Roth IRA account, you put that in that account, and that money, it's going to grow tax free. So that's a benefit of Roth IRA. The money is going to grow tax free because you already paid taxes on that money. So 401k, it's basically the money you put in investment account before tax, and later on you pay taxes on. So an IRA or IRA is basically you put the money after tax and your money grows tax free. So remember, avoid debt. We're going to wrap up this video by just reviewing quickly. Avoid debt. Don't buy that expensive car yet. Build a business. Invest in something that later on you can pay for all those expensive cars and things from your investment account or from your businesses. So I hope this was useful for you guys. Avoid debt. Avoid those financial investors that they're very expensive, and you put your money in index funds. You don't have to watch it. Go to sleep at night, because there's a lot of people have money in those index funds, and Vanguard is probably the best one. The reason is the best one is probably it has the lowest rate. They charge you very, very little for the work they do for you, and they manage the account. So the risk is very low because you're investing basically in a bunch of companies, not just a single company, and over time your money always, remember I told you, always is gonna grow. So let me know your thoughts. Give it a like, subscribe to my channel, and I hope to see you next time. Bye.